has finally arrived, Fed decision day. Many expecting the Federal Reserve will raise rates for the first time in 7 years, including former Philadelphia Federal Reserve President Charles Plosser, who joined us yesterday.
I don't see anything on the horizon that's going to suggest that they've got an excuse not to go ahead with the plans that they've signaled pretty strongly.
And joining us right now is Bank of America Deputy Chief Economist Meyer and Oppenheimer Funds Chief Investment Officer and Head of Fixed Income Krishna Memani. Good to see you both. Thank you so much for joining us.
Thank you.
Is it just that we should expect the Fed's going to raise today? What's the impact, Michelle?
Yeah, I think the Fed very much will raise. They've communicated that pretty clearly. I think the key question is what's the language accompanied with that rate hike? How dovish will the Fed be able to deliver a message? And I think the markets are looking for very, very cautious sentiment. My concern is that they won't be able to deliver quite a dovish message.
So we see a rate hike today then, Krishna, and then all eyes are on sort of the language in terms of what 2016 looks like and the pace of further rate increases.
Absolutely. I don't think the first rate hike is important. What happens in 2016 is far more important. And our expectation is the regime change at the Fed will probably cause tremendous amount of volatility in the marketplace in 2016. We'll get good returns, but we'll get those returns with volatility. And the reason is, while they would say that they are going to be gradual, people will believe them at the outset. But when we print 3% numbers, well, they're behind the curve, and they'll be far more aggressive, and then we'll have rates rising very rapidly. Eventually, things will settle down, but I think it'll be periods of volatility every so often.
And of course, Dagan, if it's about the data, we got to see better data when it comes to GDP and other things. I mean, certainly right now, the best data point has been the jobs numbers.
Jobs numbers, unemployment rate, Janet Yellen being a very big fan of the unemployment rate. Wages are growing, although that not fast enough as many people would like, but there's enough good news that they can justify moving at this point, although I think we'd all agree they should have moved earlier this year, if not earlier than that.
They blew it in September.
That the rate should be a great deal higher than 1/4 to 1/2 percentage point.
Well, I would say that yes, I think if you just look at the U.S., you can make that case pretty easily. However, if you look at in a global context, things are actually, are slowing down meaningfully in emerging markets, and there are those considerations that we have to factor in. Because if we tighten unilaterally while the rest of the world is slowing down, it leads to a significant strengthening of the dollar, and that slows the U.S. economy down, not just through the export sector, but through our domestic economy
I think you're hitting the nail on the head here, because what's happening is the data, especially on the manufacturing side where everyone's freaking out, it's the globe is impacting our manufacturing data, and we can't have those exports as well as the dollar's getting stronger, right? So it's not necessarily, the U.S. economy is doing just fine, and this is only 25 basis points. We're looking at the 12-month Treasury sitting at 67 basis points, right? So, I mean, that's already had the move, anticipating maybe 75 basis points on Fed funds at the end of next year, right?
So 3 more rate hikes in 16.
Yeah, 2 rate hikes. 2 in
16, include, and then this one. So that's so only 2. You're only looking at 2 increases in 16. That's what you're expecting.
Yeah, exactly.
And that's what the market is saying as well. And if that's what the Fed delivers, then it should be fairly contained, because that's what's being priced in. I think the question is, will the market actually exceed those expectations? And then you get an incremental tightening in financial conditions, and then you get the volatility akin to what Krishna's talking about.
I think today that is really their challenge. They would like to be gradual, but their dot plots are at different points, and the market is at a totally different point. How do you bridge the gap, I think, is Janet Yellen's challenge today.
Yeah, it's really interesting what you all are painting here, because if the market sees that the Federal Reserve is as gradual as you're talking about and as sort of just reserved, isn't that a negative? It tells me that the economy is slow. It tells me that the Fed has its hands tied, can't do much, because we're talking about a very slow fundamental backdrop.
Well, we have moved, so the regime has changed. The economy is doing well. That's why they're tightening policy. However,
are they tightening because they are up against the wall and their credibility is on the line?
And but you sound like you don't. If you were one of the governors or one of the board members, that you wouldn't move based on the rest of the world, because you worry about the dollar.
I do. I think given the risks that we face, they don't accomplish a great deal by tightening today. Doesn't mean that the U.S. economy is not good enough. I think it's just that given the global picture, this particular regime change may cause volatility that we could do without.
Except that they look like scaredy cats because we're not, this country is not in a crisis. These are crisis level rates.
Yeah, but you know what? I don't want the Federal Reserve to raise just because the Fed has its back up against the wall and is about to lose credibility. I want the Federal Reserve to raise rates because of real fundamentals. I know you're saying that the fundamentals are there, but there is a debate.
We are way too drunk off of this low rate policy. I mean, there's been this chase for yield. You saw a freak out happen in the junk yield market because of this, right? Because the punch bowl has been there and everyone's stressing for yield. So you've got to take that away. You've got to remove the excesses from the economy. It's normal to have a recession, by the way. I mean, normal business cycles need to happen. The Fed can't be there every single time.
So you're saying no big deal if we go into recession in 16?
I think that will be a big deal.
That would be a really big deal.
I think the point is that the Fed is supposed to smooth business cycles, but they're also supposed to allow for some turns in the economy. So you don't want to have a situation where the Fed is too accommodative, it creates asset bubbles, it creates financial market disruptions, and then when they do have to adjust policy, it's very disruptive. And I think that's what the Fed is trying to do now, is saying, listen, we know that we're at a 5% unemployment rate. Conditions have been met. Let's go slowly and allow for some smoothing of the cycle.
And we don't care if you've lost money in high yield because that was a bet you made and we're not going to bail you out.
And it's not on the bank's balance sheets,
Let me follow up on that because, Krishna, I want to get your take on what's been going on. I mean, Third Avenue and the blow up of the funds there, and now everybody's worried about other credit funds. You know, they froze cash withdrawals from that $800 million high-yield bond fund. Are you expecting more trouble in the high-yield bond market?
So the liquidity environment in high-yield market is much worse than it has been in the past. However, I think the structure of that particular fund was a distressed fund focused on the low end of the market where there isn't a whole lot of liquidity. So that, I think, to some extent, while it was unexpected, I think you see these types of accidents happen. Our expectation is that it's an isolated event. You don't see that carry through the rest of the market. And that's how things have been working out over the last few days.
All right, so you're not so worried about it. All right, and real quick to you both. Fed raises a quarter point. What does the market do?
I think the market has a relief rally.
Relief rally?
I think so. Yeah. Because they will go out of their way trying to convince the market that they're going to be gradual. I think the risk and the volatility is not today. It's at the end of the first quarter when we have a 3% growth rate.
Because that tells us more rate hikes are coming.
Exactly.
You agree with that analysis, Michelle?
Yeah, and I think that's the consensus of our equity analysts as well. Sabita and crew think that you can see actually some move higher in stocks. But it very much depends on the communication. And also going into year end, things are a little more illiquid, so there could just be a lot of noise around it.
All right, we'll leave it there. Great to see you both. Thank you so much, Michelle Meyer, Krishna, Memani. We'll see you soon. Thank you.
Thank you.